In August 2026, we signed a definitive agreement to acquire 100% of an account-to-account payments company for an initial payment of approximately $143 million of cash. The terms and conditions also include contingent consideration of up to $173 million, resulting in an aggregate maximum consideration of approximately $316 million. The acquisition is expected to close in the second half of 2026, subject to customary regulatory approvals. Gross revenue increased by $329 million, or 34%. Gross revenue is comprised of payments-based revenue, TFS revenue, and subscription and other revenue. Payments-based revenue increased by $205 million, or 24%, primarily due to the increase in volume of $11 billion, or 22%, for the 3 months ended June 30, 2026, compared to the 3 months ended June 30, 2025, and our recent acquisitions. TFS revenue increased by $117 million. TFS revenue is the result of the acquisition of Global Blue in the third quarter of 2025. Subscription and other revenue increased by $7 million, or 7%. The increase in subscription and other revenue was primarily driven by the impact of recent acquisitions. The 21% increase in network fees was primarily due to the increase in payments-based revenue. Gross revenue less network fees increased by $211 million, or 51%, primarily due to the impact of recent acquisitions, the increase in volume, and higher subscription and other revenue. The increase in other costs of sales was primarily driven by our recent acquisitions and incremental residual commissions associated with revenue growth. The increase in general and administrative expenses was primarily due to expenses associated with our growth, which includes the impact of our recent acquisitions. The increase in depreciation and amortization expense was primarily due to the amortization of intangible assets recognized in connection with recent acquisitions and increased depreciation of equipment under lease associated with our growth. The decrease in interest income was primarily due to a decrease in our average interest-earning cash balance. The increase in interest expense was primarily due to new debt issuances in 2025 related to the acquisition of Global Blue. The effective tax rate for the 3 months ended June 30, 2026 was approximately 34%, compared to the effective tax rate for the 3 months ended June 30, 2025 of approximately 26%. The effective tax rate for the 3 months ended June 30, 2026 was different than the U.S. federal statutory income tax rate of 21%, primarily due to the mix of income and valuation allowances in various jurisdictions. Gross revenue increased by $602 million, or 33%. Gross revenue is comprised of payments-based revenue, TFS revenue, and subscription and other revenue. Payments-based revenue increased by $366 million, or 23%, primarily due to the increase in volume of $22 billion, or 23%, for the 6 months ended June 30, 2026, compared to the 6 months ended June 30, 2025, and TFS revenue increased by $219 million. TFS revenue is the result of the acquisition of Global Blue in the third quarter of 2025. Subscription and other revenue increased by $17 million, or 9%. The increase in subscription and other revenue was primarily driven by the impact of recent acquisitions, as well as higher SaaS revenue associated with our technology solutions. The 20% increase in network fees was primarily due to the increase in payments-based revenue. Gross revenue less network fees increased by $391 million, or 50%, primarily due to the impact of recent acquisitions, the increase in volume, and higher subscription and other revenue. The increase in advertising and marketing expenses was primarily due to incremental brand awareness costs. The effective tax rate for the 6 months ended June 30, 2026 was approximately 42%, compared to the effective tax rate for the 6 months ended June 30, 2025 of approximately 10%. The income tax benefit for the 6 months ended June 30, 2026 was primarily due to a discrete tax benefit resulting from the simplification transactions and the mix of income and valuation allowances in various jurisdictions. For the 6 months ended June 30, 2026, net cash provided by operating activities of $197 million was primarily a result of net income of $36 million, adjusted for non-cash depreciation and amortization of $274 million, equity-based compensation of $47 million, and provision for bad debts of $13 million, partially offset by deferred income taxes of $21 million, and an impact from working capital items of $152 million. For the 6 months ended June 30, 2025, net cash provided by operating activities of $238 million was primarily a result of net income of $61 million, adjusted for non-cash depreciation and amortization of $173 million, equity-based compensation of $41 million, amortization of capitalized financing costs, net of premium accretion of $9 million, and provision for bad debts of $6 million, partially offset by deferred income taxes of $21 million and an impact from working capital items of $32 million. Net cash used in investing activities was $89 million for the 6 months ended June 30, 2026, a decrease of $43 million compared to net cash used in investing activities of $132 million for the 6 months ended June 30, 2025. This decrease was primarily the result of $185 million of settlement cash acquired from Bambora in March 2026 and a $10 million decrease in deposits made with our sponsor bank, partially offset by a $110 million increase in net cash paid for acquisitions, excluding settlement cash, a $23 million increase in capitalized software development costs, and a $10 million increase in acquisitions of property and equipment. Net cash used in financing activities was $518 million for the 6 months ended June 30, 2026, an increase of $2,144 million compared to net cash provided by financing activities of $1,626 million for the 6 months ended June 30, 2025. This increase was primarily due to a $2.3 billion of gross proceeds received from debt and equity issuances in 2025, a $173 million increase in payments for the repurchase of common stock, a $122 million increase in distributions to non-controlling interests, and a $31 million increase in preferred dividends paid, partially offset by the $450 million repayment of our 2026 senior notes in 2025 and a $42 million decrease in deferred financing costs. As of June 30, 2026, we had $4,549 million total principal amount of debt outstanding, including $633 million of 2027 convertible notes, $1,650 million of 2032 senior notes, $1,271 million of 2033 euro notes, and $995 million of principal outstanding on the term loan facility. As of December 31st, 2025, we had $4,589 million total principal amount of debt outstanding, including $633 million of 2027 convertible notes, $1,650 million of 2032 senior notes, $1,309 million of 2033 euro notes, and $997 million of principal outstanding on the term loan facility. As of June 30, 2026, there were no borrowings outstanding under the revolving credit facility, and the borrowing capacity on the revolving credit facility was $550 million. We have a settlement line agreement with an aggregate available amount of up to $125 million. As of June 30, 2026, borrowings against the settlement line amounted to $106 million, which have been deposited in an account owned and controlled by Citizens. The deposit and borrowing have been netted on our unaudited condensed consolidated balance sheets because a right of offset exists and the parties intend to net settle. In November 2025, the board authorized a new stock repurchase program, replacing the prior program, pursuant to which we are authorized to repurchase up to $1.0 billion of shares of our Class A common stock through December 31st, 2026. During the 6 months ended June 30, 2026, we repurchased 6,137,500 541 shares of Class A common stock for $320 million, including commissions, at an average price of $52.17 per share. As of June 30th, 2026, $375 million remained available for stock repurchases. As of June 30, 2026, we had $4,549 million of debt principal outstanding, with $10 million payable within 12 months, and future interest payments at current interest rates associated with the outstanding debt totaled $1,556 million, with $242 million payable within 12 months. As of June 30, 2026, we had 10,423,296 shares of our preferred stock outstanding, with an aggregate liquidation preference of approximately $1.0 billion. Dividends on the preferred stock are cumulative and accrue at an annual rate of 6.00% on the liquidation preference, payable quarterly in arrears, when and if declared by our board. Subject to declaration, expected cash dividend payments on the preferred stock total $63 million over the next 12 months. As of June 30, 2026, the fair value of contingent liabilities to potentially be paid out in cash was $13 million, with $9 million payable within 12 months. As of June 30, 2026, the maximum amount of contingent liabilities to potentially be paid out in cash was $22 million, with $13 million payable within 12 months. On June 14, 2026, Nancy Disman, a member of our board, entered into a new trading plan pursuant to Rule 10b-5 of the Exchange Act. Ms. Disman's Rule 10b-5 trading plan provides for the sale from time to time of an aggregate of 40,000 shares of our Class A common stock. Ms. Disman's Rule 10b-5 trading plan becomes effective on September 16, 2026, and expires on September 16, 2027, or earlier if all transactions under the trading arrangement are completed.